All right, let's get started. For those of you who've just joined us, welcome to our webinar on global assets and taxing rights. Today's webinar will be presented by myself, Khutso, as well as my colleague, Graham Smith. We form part of the tax team at SAIL International as global tax specialists. Before we get started, please just note that your mics have been muted and your cameras are off. So if there are any questions that come up during the presentation as and when we go along, please feel free to drop them in the chat box and we will attend to all your questions at the end of the presentation. Now, just a little disclaimer before we get started. Please note that this presentation is generic advice. Tax legislation is quite vast and complex, and it changes frequently for those of you who follow the budget speech on an annual basis. So we do not state that this presentation is complete. So as a result, we please urge you to consult one of our tax advisors if you have any questions regarding any tax consequences for your specific situation. Right, now that we've got that out of the way, today's webinar is essentially about you, your journey, your investment to global assets, and some key considerations that you need to consider along the journey. Now, what we're going to be looking at is what global assets are more generically, where these assets will be located and the tax implications that follow as a result, where you are located and how that affects the tax on your global assets. And then we'll delve into more technical terms such as your double tax agreements and how they help, and ultimately the end goal, estate and inheritance planning. Once again, if you have any questions that come up during our presentation, please feel free to drop them in the chat box and we will attend to them at the end of the presentation. All right. What are global assets? So when we speak of global assets, generally, we speak of assets that are outside your home country. So these can fall within either of the below categories. They can either be physical assets in the form of commercial or residential properties, your antiques, your collectibles, or they can be non-physical assets. So assets that don't have a physical or material form, but they still have a certain monetary value attached to them. So this is anything from your listed or unlisted shares, your unit trusts, your retirement or pension funds. In our ever-evolving global economy, there's been an emergence of what we refer to as digital assets. So these are your cryptocurrencies, your Bitcoin, your Ethereum. Now, for purposes of this presentation and to make some of this information a little more digestible, we've put together a little bit of an example. So imagine hypothetically your financial planners approached you to diversify your asset portfolio. Now, in an attempt to do this, you invest in a UK property limited company, some shares or share portfolio that are sitting or held in the USA. You've got two rental properties, one in Joburg, obviously, and the other one in Cape Town, the Windy City, as well as a retirement annuity. Now, as and when we go through the presentation, you'll see a common thread. Although we won't specifically be considering these taxes or how they affect or how they are calculated, you'll just notice a common thread throughout the examples and throughout the key considerations that we are trying to shed light on, such as your income taxes from things like your rental properties, your capital gains tax when you dispose of these properties or assets, corporations tax, or what is often referred to in South Africa as companies tax, withholding taxes, and the ever forgotten estate duty and or inheritance tax. So where are your assets located? Now, first consideration when you invest in global assets is to take into consideration where these assets will be. Source principles are usually guidelines that we use to determine the source of the income for tax purposes. So these principles usually help us in determining which country's tax laws will apply for a particular type of income or for a particular type of assets. Now, different foreign tax jurisdictions will have different rules that apply to the assets that are considered located and or sourced within their tax jurisdiction. And it gets relatively easy when we look at physical assets, because if we take it back to the examples, your physical assets, so the UK Property Limited Company, because the majority of those assets is property, UK based. Your share portfolio, USA, because it's managed and is held in the USA, source would relatively be simple, USA. Same as your South African property and same as your retirement annuity. But source principles get a little bit more complex when we start looking at your digital assets or your non-physical assets, in the sense that we need to go a step deeper and speak about the originating cause versus the dominating cause. For instance, when we speak about the originating cause, we'd be looking at where does that income and or that asset originate? Most easily explained with employment income. If you were to get employment, say, for instance, in the UAE, but work remotely in South Africa, the origin of that specific income or the income that you're earning as a result of that employment is you physically sitting and rendering the service in South Africa. So the originating cause would be South Africa instead of where the company might be situated. Now, common thread throughout our example, the originating cause for your property limited company would be where the majority of the assets are held. Your USA portfolio, because it is managed and held in the USA, again, that would be where the originating cause of that income comes from. Same with your South African property and same with your retirement. Same with your retirement annuity. Now, source principles, unfortunately, are not the only tax considerations that you need to take into account. If it were that simple, we'd be done with the presentation and everyone would be logging off right now. But unfortunately, we also have to look at where you are located. This is what we often refer to as tax residency. Now, tax residency, in a nutshell, determines that you are taxable in the country that you are in on worldwide income as well as worldwide assets. Now, can be based on a number of things. There are some countries that base tax residency on domicile, some countries base tax residency on citizenship, and there are some countries, like South Africa, that have specific tests that determine your tax residency status. Now, in South Africa, tax residency is based on two tests, one primary and one secondary. First primary test is what we refer to as the ordinarily resident test, which looks first at your intention. Where do you want to be? Where would you like to consider home, or where would you like to consider ordinarily resident? Now, this intention test can get quite subjective. So SARS will look at certain objective factors to support or point towards your intention. Yes, things such as where's your employment? Where's your spouse? Where are your children? Your political, your social, and certain economic relations. All of these are set to just solidify the fact that your intention is as you say it is, essentially. Now, it's the primary test because SARS will always look at this test first. The secondary test is what we refer to as the physical presence test. Now, the physical presence test is a day's test. Please remember that a half day in SARS's eyes is a full day. Essentially, sorry about that, is still considered a full day. Now, physical presence test is often used for foreign nationals or alternatively individuals that have previously declared non-residency with South Africa. And how it works is it'll look at a 6-year test. And in that 6-year test, have you been physically present in South Africa for 91 days each year, each tax year, before you are considered tax resident in year 6? Now, cumulatively, all those previous years has to be a total of 915 days. So it's more rigid than the ordinarily resident test. Now, if we were to go back to our example, let's say we apply either of the two tests that I've just mentioned earlier, and you are considered South African tax resident. This throws a little bit of a spanner in the works. So your UK property limited company and the income that comes from there, either from rental or from the sale of any property, now gets taxed both in South Africa because you're tax resident and in the UK because that's where the asset is sourced. Same with your USA share portfolio. It now becomes taxable in South Africa because you are tax resident here, as well as in the USA because that's where the asset is sourced. Now, your South African assets, relatively easy because they stay the same and they stay taxable in the same tax jurisdiction. It gets a little bit more difficult when you get offered, maybe offer an employment, say in the USA, and you start earning dollars without breaking South African tax ties. Then what happens is that you run the risk of adding additional tax residency statuses to your situation. So if you were to look back at the same example, if you trigger tax residency, say for instance in the USA, now we've added an additional tax residency country. So UK Property Limited Company becomes taxable in South Africa because you haven't broken your tax residency there. It now also becomes taxable in the USA because you may have triggered tax residency by physically being in that country as well. But it also gets taxed in the UK because that's where the asset is situated. Same with your USA share portfolio, now taxable in the USA because you've triggered residency, also because it's sourced, and also in South Africa because you haven't broken tax ties. Now, the previous assets that were unaffected because you were physically sitting in South Africa now get affected. So your South African rental properties are now taxable in South Africa because that's where the properties are situated, as well as in the USA because now you may have triggered residency in that country as well. Same with your retirement annuity. So from this example, it's clear that if you don't plan properly, i.e. your movements abroad, especially when you move towards investing offshore or investing in global assets, the difficulty becomes you open yourself up to a significant amount of tax leakage. And this is where you need to then maneuver, reassess, and realign in order to see where can you plug the leakage essentially. Now, to talk about helping to minimize the impact of double tax, I'm going to hand over to my colleague, Graham.
Good morning, everyone. Thank you, Khutso, for that introduction and getting us started. As Khutso said earlier, my name is Graham Smith. I'm also one of the global tax specialists at SAIL. Right, so leading off from where Khutso left off, there's another important thing to consider, which is double tax agreements. So double tax agreements essentially their purpose is to minimize the tax that is payable in one country or both countries, where you are tax resident in more than one country. As Khutso mentioned, where you might become tax resident in the UK or in the USA, but have assets in the UK and still have assets in South Africa. The purpose of the DTA is to reduce that as much as possible so that you're not taxed twice. So South Africa has DTAs with 42% of the countries in the world, which is 82 of the 195 countries. Most of the DTAs are with more of the major countries, such as USA, the UK, a lot of your European countries, Australia, New Zealand, but there are some countries that they don't have DTAs with, and then different laws apply. Right, so there are also different provisions and laws that apply based on the type of person that you are. Whether you're as an individual, a company, or a trust, there are different laws that apply to different types of income. Income such as interest will be taxed differently to dividends, which is different to rental income. So each provision has to be looked at separately per income type. Now, as Khutso alluded to earlier, there are two types of South African tax residency normally: ordinary residence and physical presence test. Now, under the DTA, this gets even trickier. There's an additional clause that comes in, which is referred to as the tie-breaking laws under a DTA, where you are then assessed on such things as your permanent home, where your economic relations are, habitual abode, and you go through the steps as so. And basically, in the end, you work out where you would be deemed tax resident to be, and that country has priority taxing rights. Now, that doesn't mean the other country doesn't have taxing rights. It just means that South Africa may have taxing rights in priority over the UK because you are a South African ordinary resident and you live in SA. You might have never been to the UK, you don't have a permanent home there. So SA is your number one taxing country. To give that an example, let's take dividends, for example. USA has a 30% dividends tax rate. South Africa only has a 20% dividends tax rate. So if you add them together, you'd be paying 50% tax, 20% here, 30% over there. Under the DTA, this is reduced to 20%. So you're only paying the South African rate, and then you get a foreign tax credit against the income in USA. And John, go to the next slide, please. So with that, there are specific provisions that apply, specifically DTAs, but you don't have to panic if you have assets in a country that doesn't have a DTA with South Africa. There are still certain tax reliefs that apply. Though they may not be as beneficial as a DTA country, you still get foreign tax credits, normally referred to as 6-quart rebates, on any foreign tax paid. When you submit your South African tax return, you can declare that against your foreign income and you'll get a rebate or deduction on that foreign tax paid. Same thing with withholding taxes, as I mentioned earlier. You declare them in your return, even though they were previously withheld, you declare the gross, and then you get an amount back on the net based on the tax paid. So there are also certain provisions that apply, such as retirements and retirements and pensions that may exempt it from being taxed in one country. So such examples are the UK and New Zealand, where it is only taxed in the country in which you are resident in. So if you've ceased tax residency in South Africa and you've moved to New Zealand, you may then be able to withdraw your pension tax-free in South Africa and only have it taxed in New Zealand. Though then it might be taxed in New Zealand at whatever their rates are, they might be taxed more, but in certain cases you can save a lot of tax if applying the DTA correctly. Thank you. Go to the next slide. Now, in life they say there's only 2 guarantees, death and taxes. And sadly, when you die, it doesn't mean your taxing ends. You are still taxed when you pass away, as well as in your estate once after that. But in simple terms, South Africa applies estate duty. Other countries like the UK have inheritance tax. South Africa's estate duty is 20% on the first 33 million of your dutiable estate and 25% on the amount above 30 million. You're also entitled to a 3.5 million rand abatement, but this comes in once your tax is calculated, you get it off at the end. South African ordinary residents pay estate duty on their worldwide assets. So it is quite sad that you could have assets overseas and it's still taxed in South Africa, and it's taxed at that 20% rate, and it will also be taxed in that other country. So it's very important to have 2 separate wills, one for your South African assets and one for your foreign assets, just to provide clarity and confirmation of where all the assets are, and then it also provides you an extra layer of who has taxing rights in certain cases. There are only 8 countries that South Africa has double taxation agreements in place for estate duty. So for the other countries, either you apply the normal DTA or you don't get relief in that way. So therefore, you have to go back to your 6-quart rules. So from this table, if we go back to the example, if you were living South African ordinary resident, but you've now triggered UK tax residency as well, your limited property is going to be taxed in the UK, in South Africa, and in the US. And then you apply the tax credits afterwards. Your share portfolio will be taxed in SA as an ordinary resident and in the US because it's situated there and you've triggered tax residency there. Your properties will be taxed both in South Africa due to be physically present in SA and in the US due to you becoming tax resident there. And then your retirement annuity is also taxed in both countries. However, if you look at the DTA, you may be able to get one of them tax-free when you withdraw it, or under the DTA, it might only be taxed where it was sourced from. So there's quite a few different ways that estate duty can catch you, and it's not the best situation, but you think at the end of it, you still have to plan that you have enough funds in order to pay the estate duty, as well as hopefully leaving something to your loved ones. Now, with all of this said, it's always important to reassess and realign. SARS cannot stop you from structuring your assets and income to be the most tax efficient way possible. With that said, it still has to be in a legal way. You can't just stuff all your money under your mattress and say, oh, I'm being tax efficient. You got to follow the laws and legislation that has been put in place for every type of income that you earn, and how every type of asset is taxed, whether it's income tax, estate duty, corporate tax, and so on. So with that said, always reassess and come back to the best way possible in how to do it. There's many ways that this can be done, such as taking advantage of exemptions and allowances that apply, once-off tax breaks, for example, such as the solar incentives that came in for the last 2 tax years, 1 year for individuals, 2 years for companies, and any other types of entities structuring wise, whether you put your assets into a trust so that they don't fall part of estate duty, or forming a corporation so it's taxed at a lower rate and then you pay yourself a salary from that. All of these are different ways to mitigate tax risk as well as reduce tax payable if done effectively and correctly. So with that said, how can we help in this? This is what we specialize in. This is our area of expertise. It is always advisable to seek tax advice from someone who has better knowledge on the topics, and we can help with this. We offer global tax advice, so not just South Africa, but anywhere in the world that you're situated, whether you're leaving South Africa or returning to South Africa, moving to new countries, we can provide you with this. We offer a free 15-minute consult to, get you started, answer any questions you have, and then from there we can go in further and see how we can help you. Thank you guys very much. That brings us to the end of the presentation. Do you guys have any questions for us?
All right, so I'm going to stop sharing my screen just so we can attend through any questions that may have come up in the chat box. If any, I'm just going to give you guys a couple of minutes. If you do have any questions, please feel free to drop them in, and then, we'll continue. But Graham, just to get a better understanding on global tax structures and how this can help. If I were to, for instance, structure my assets in an offshore company or an offshore trust, does that then eliminate estate duty, or how would that better assist, mitigate my taxes for when I pass on and unfortunately have to give my assets to the kids?
Yes, so it doesn't mitigate it 100%. It depends on who owns the shares in the company. So if you as an individual still own the shares in that foreign company, you'll still be liable to estate duty on the market value of the assets or the equity value of the company. But if you then went a step further and set up a foreign trust that then owns the company and you were a beneficiary of the foreign trust, you would then not be taxed on the value of the company, because a trust never dies. It continues generation after generation, and that way you would then save tax in that way, and you just distribute the funds out to your beneficiaries. Though depending on your residency status, there's more complications there. So I would then say, give us a call.
Sure. And another thing, just, is non-residency automatic? I think we've come across quite a few questions that say, well, I've left South Africa. So that means I'm not tax resident anymore because I don't live there. They don't have a right to tax anything that I own. So does it automatically apply?
No, definitely not. No matter what, you always are taxed in South Africa. If you have a tax number, even if you're born here and you've left before you ever had a tax number, you technically would have been ordinary resident in South Africa. So you should be liable for tax. You always have to follow the full process and cease tax residency. So, for example, if you've just left, you've never earned income, or you had a small part-time job, paid a little bit of tax, rather cease tax residency now while you have no foreign assets. That would attract exit tax or capital gains exit tax. And then down the line, all of your foreign income is protected from being taxed in South Africa.
Definitely. And I think this is more leading from what you said. If, I do the process and I do leave South Africa because I have a better job somewhere else, the rand is not doing that great. And eventually I want to then return to South Africa because, life didn't work out as well as I thought it would. Does that negatively impact my global assets? Do I then have to come back and become a South African tax resident, be taxed on all the global assets that have been acquired since I've left?
SARS will welcome you with open arms and gladly take your money, but you will get an exemption for the period that you were non-tax resident for. So if you left and you bought an asset and they say you were non-resident for 10 years, but you owned it for 20 years, you'll only be taxed on the growth once you became South African tax resident again. So you still will get taxed, yes, but at least there is some factors that will limit the amount that you taxed on. So then once you come back, reevaluate your assets, get them revalued, and then you taxed on the growth from there.
Perfect. I'm going to stop interviewing now. I'm hoping that we've presented so well that nobody has any questions or anything sort of put through to us. But I'm going to leave up our scan so that you guys, if you do have a question and you're just feeling a little bit uncomfortable to put it forward to us, you're more than welcome to book a free 15-minute consultation just to understand. I'm looking to invest on cryptocurrency because everybody's doing that these days, and I want to know how this is going to impact me. What do I need to consider when I look at my taxes? What do I need to look at? We're happy to assist. All right, so I think we're going to close off the webinar for today. Thank you guys so much for taking the time to be with us and to run through the presentation with us. Again, if you have any questions for either myself or Graham or any other tax advisor out there, please feel free to reach out to them. It is an important consideration if you're looking at investing offshore. And yeah, have a lovely day, everyone.
Thank you guys very much.
Bye.
Cheers. Bye.